Okay, good morning everyone and welcome to MACROACE. I hope you guys had a wonderful festive period, Christmas and New Year's if you celebrate those. I myself had a decent festive period. It was nice and quiet. But other than that, let's get straight into it. We've got non-farm payrolls and Canadian employment change, both bits to cover, which are going to either help drive sentiment for Fed rate cuts this year or diminish those rate bets for this year from the Federal Reserve. So non-farm payrolls, let's get into it. So first thing, what is it? It represents the net amount of jobs that have been created within the prior month. Okay. And you have the household survey and you have the establishment survey. The household survey represents the unemployment rate. Okay, and the establishment surveys about 666,000. Forget the devil's number. 666,000 corporate and government work sites about how many new jobs that they have created, and that is seen as a more reliable report because it's from businesses rather than from people, rather than from the everyday consumer instead. So how does it affect the markets? With the currency, if you do see stronger than expected payroll figures, it leads to a strengthening in that currency for the dollar because it shows that the economy is quite strong. New jobs are being added. There's confidence that's going to returning to the labor market enough for businesses to be able to add new jobs. So it's quite important that occurs. That you do get stronger than expected payrolls report for a stronger, more bullish reaction from the dollar. On the flip side for stocks, if you do get a stronger than expected report, however, it could lead to a decline in the expectation that the Federal Reserve and the rate bets are going to be pushed out further, and there may be less rate cuts than expected potentially as well. So that's how the stock market can react to it, particularly in this point where we're seeing the Federal Reserve starting to make their pivot. Of course, first of all, within their language of what they've been saying so far, from going from tightening to being open to the idea of rate cuts. Of course, with the SEP or the Summary of Economic Projections, where we had started to see more Fed members look to rate cuts this year compared to what we have seen previously. For the bond market, bond yields usually see a rise in their value if you do get stronger than expected non-farm payrolls data. Two reasons. One, that the Federal Reserve is going to be less inclined to cut rates this year, or not this year, or less inclined to cut rates by as much as what the markets expect them to, and maybe cut by less, or push out the idea of a rate cut further on into the future. Point number two is if the economy is healthy and strong, usually what happens when the cycle in a tightening cycle, or outside of a tightening cycle, should I say, when the economy is nice and stable, if the employment data is stronger than expected, that leads to traders taking riskier trades or investing into risk assets instead of safe haven assets, which would be government bonds, which don't really give you that much of a yield or that much return. So what the government would usually do is that when you see that investors and traders sell off bonds, yields naturally go higher, but also the government, when they issue bonds too, they will also set it at a high yield for a lower price as well to try and attract investors. Say, hey, buy our debt and we'll give you a nice high yield on top of it too. So positive for the bond yields, for bond yields if data is stronger than expected, and vice versa, bond prices will go lower. Unless you start to see a weaker, more anemic jobs report, then you would see bond prices going higher and bond yields going lower, because there's the expectation that the economy might be faltering and traders might need to hedge. They might need to contain their risk, and also the other side being that the central bank may might start cutting rates sooner than later, the more markets might already be expecting. So indicators weighing on sentiment then, how is the economy performing overall? What's weighing on the non-farm payrolls data? Inflation at 3.1% compared to 3.2%. The PC price index, which is a favored measure of inflation for the Federal Reserve, at 2.6% compared to 2.9%. GDP for the third quarter at 4.9% compared to Q2 of 2.1%. ISM manufacturing employment at 48.1 compared to 64.5. Manufacturing PMI 47.4 compared to 46.7. Services employment at 50.7 compared to 50.2. Don't forget, today you get the ISM non-manufacturing or ISM services PMI data today at 10 a.m. Eastern Time. Services PMI was at 52.7 compared to 51.8. JOLTS, which we had this week, was at 8.79 million compared to 8.733 million. Employment cost at 1.1% for the quarter compared to 1%. And ADP employment change, although there was a big deviation from the forecast, I think the forecast was for 140k maybe, and the data came in at 164k compared to the prior 103k. The market didn't really move that much, so there's more of a, it's more of a, well, first of all, you're coming out of the new year, you're coming out of the holiday season, so the amount of liquidity that was available wasn't really there that much. Now traders are coming back in and pricing in their expectations for the Federal Reserve, and also setting themselves up for non-farm payrolls too. So the market reaction wasn't that strong for ADP employment change as it has been in the past. So it's more of a markets, trade participants are coming back into the market, and then now they're waiting the big dog release of the week, non-farm payrolls, to kick off the new year. Average earnings year on year was unchanged at 4% as well. Now then, the triggers for the economic release. So non-farm payrolls, we have according to economists, they see a high estimate of 235k with a 60k deviation. Low estimate of 80k, and that's about a 155k deviation. So quite a big range there that you're seeing for the high and low expectation for non-farm. Unemployment rate 3.9 compared to with a low of 3.7. Average early earnings with a high for the year on year with a high estimate of 4% compared with the low estimate of 3.8. And private payrolls too with a high estimate of 190k and a low of 60k. So bearing in mind, you could have a slightly positive payroll non-farm payrolls figure, but the private payrolls data or the other bits of data combined, if they're quite bad or if they're much lower than expected, then if when I say bad, I mean less than expected figures, then it could mean that the market then focuses on the other points of data rather than the non-farm figure itself, if there isn't too much of a deviation. What I mean is, overall, if there isn't too much of a deviation on the figures either, then the market reaction might be quite choppy. So then you're entering into waters that you probably don't want to be into. So that's a caution there. However, if you do get much stronger than expected non-farm payrolls figure, and we do get more of if we do go above 235k or below 80k, then you would expect a nice strong reaction from the markets, and the markets will take focus and look at that instead. Okay, and then the previous report for November on December the 8th. So employment showed little change over the month in other major industries, including mining, quarrying, oil and gas extraction, construction, wholesale trade, financial activities, professional business services, and other services. So a breakdown had healthcare added about 77k, government about 49k, jobs, manufacturing about 28k, leisure about 40k, social assistance about 16k, retail trade about 30, and deficit or decline of 38k, information or technology plus 10k, and transportation warehousing was minus. There were 5,000 fewer jobs that were added in the November period. Okay, So then if we look at the Fed and government views, just looking more or less at the Fed views here, but we had Fed's Harker on December 20th saying that the soft landing process will likely be bumpy. Bostic said on the 19th of December that sentiment about the economy may become more positive if wage gains continue to outpace inflation. Our outlook is for continued cooling in inflation and labour. Fed's Daily on the 18th said that 3 rate cuts could be needed in 2024 to avoid over-tightening. That was according to the Wall Street Journal. And then Fed's Goolsbee said the economy can keep growing while inflation cools if we keep getting improvements of the supply side and improvements in labor force participation. Then the economy doesn't have to weaken for inflation to come down. So there could be a shift in the Fed's view that if inflation is already coming down, but there is still a strong labor market, then the idea of a decent report for non-farm payrolls might actually become a positive. Now that's a wait and see, really. You can't really confirm that. You have to watch for what the market reaction is, and so far the market reaction has been that it's been negative for the stock market and a positive for the dollar, because it's still an inflationary. It can still seen as an inflationary measure. The more jobs that you have, the more jobs that are created, the more people have the opportunity to then take those jobs and then increase their spending, which will then in turn affect inflation and CPI prints for later down the line in the future. Although it won't be an immediate effect, it is one of the biggest effects that has an impact on the inflation report. So that's something to bear in mind when we're looking at these comments. Sometimes you kind of have to take it with a pinch of salt that if they shift their focus from maybe the labor force to just inflation, or from inflation to the labor force, that might not be the case for them to then switch your focus to the labor force or CPI. You have to look at them all together. If that's what the markets are reacting to, okay, that's how you have to view it. If the markets are reacting to it in a certain way, then you've got to kind of keep your view of that. If an employment figure is stronger than expected and the markets don't like it, then you've got to stick with the sentiment. And when I say stick with the sentiment, just keep that point in mind that the markets still don't like strong jobs reports until something then occurs with the Federal Reserve. If they want to start cutting rates and easing monetary policy, then that view might change. But for now, it hasn't so far. Okay. White Eagle FX says, great to be here. Great to have you here. Gautam Adani says, how will NASDAQ react if non-farm payrolls goes negative? So with stock indexes, you'll see usually if you do get a much weaker than expected report, we'll go through the deviations pretty soon for non-farm, you get a stronger reaction from stock indexes, because that means that if the economy is weakening, then the Federal Reserve is more inclined or pushed towards easing monetary policy a lot sooner rather than later. And vice versa, if the jobs report is stronger than expected, then you could potentially see the inverse reaction and see the stock markets see a negative reaction, that the Federal Reserve might put off rate cuts or cut by less in 2024 or in the future. Hopefully that answers your question. So investment banking research views then. So first of all, the Fed rate impact. When the Fed started raising rates, many economists predicted that the US economy would slide into recession. It hasn't. But the US economy and job market have proven surprisingly resilient. So you have the unemployment rate that's come in at 4% or below 4% for 22 straight months. The longest such streak since the 1960s, and hiring has slowed. But remains healthy. So these are things that we've got to kind of consider as to what the effect is of the tightening cycle from the Federal Reserve so far. Usually it takes about a year or so, year to 18 months for the Federal Reserve or for interest rates to take effect on the economy. So far, it's done okay. Nothing has really shocked or rocked the markets to change their position so drastically. They've incrementally, well, it's gone the way they wanted to go, basically. 3rd of Jan, you had Bank of America's Sinha said that in the first couple of months of this year, we need to see some evidence of deceleration in the data. And if we don't get that, then some of those rate cuts can be taken out. So more or less reinforcing what I said, that if you do have stronger than expected data, then you're pushing out the potential rate cuts this year and potentially decreasing the amount that could occur for this year. Mizuho said that 2024 has kicked off with a risk retrenchment, and that was according to chief economist for Asia excluding Japan. They said that in the note that whether this is a durable purge from excessive exuberance or merely non-farm payroll profit taking is unclear. So talking about how the markets have been so far, with how the week started, with stock indexes making gradual declines over the week, with the DXY or the dollar index seeing an increase and an appreciation over the week so far, with traders rethinking about their bets for the Federal Reserve. So I tried getting the video work for the last stream that I did for non-farm payrolls, but it didn't want to work, so I got a screenshot for you guys. So this is the initial market reaction of the data last time around. You'd seen that the dollar had seen an appreciation. You see here the S&P futures had seen a decline. Now that initial whipsaw that you see, or the initial wick you see towards the upside, that was just before the figures were released. So again, you kind of got to be cautious for presumptions of what traders might do, and then you might get kicked out if you decide to hold a position before then. Be my guest. That's not what I do. But yeah, so here we'd seen a decline, a depreciation, a bearish reaction from the stock futures on the S&P, a decline in bond prices or bond futures for the 2-year bond in the US off the back of that data there. And actually gold had also seen a decline as well. So again, a more positive than expected reading for non-farm payrolls will lead to this sort of reaction here that you can see. But you have to see, but here you had data. There wasn't that much of a deviation though. It was you had about about a 16k deviation there from non-farm payrolls itself. The unemployment rate ticked lower as well, so that also helped with the market reaction. Worker week hours ticked up, average earnings also ticked up as well. But the rest of the data, there wasn't that much of a deviation. So that's also something to be careful of. If you're looking for a big deviation, the market could surprise you and decide to give you a large market reaction, even though you might not be expecting it from a smaller than expected deviation. So yeah, go figure. But as long as you're as prepared as you can be, that's what matters, rather than going into, I mean, you can go into it blind, no one's stopping you, but Hail Mary and give you some blessings. Okay, so that's non-farm for there. I'll go through the deviations on here. Let me just grab it. So we don't have too much time. No, let's just go through it. Because I also want to go through what was the largest mark. What would have seen the largest market reaction as well. Let's bring it. Okay. So this is the ranges and deviations sheet. It gives you an explanation, or it shows you how strong the markets have reacted to economic releases. In this case, we're looking at the non-farm payrolls data for December 8th. Now, we can note for the currencies that the biggest market reaction has been in the dollar yen, consistently, barring the 6th of October, and maybe some other areas here. But generally, it's the dollar yen has seen the biggest market reaction. One, because of how the Bank of Japan has been in the easing in their monetary policy for a very long time. So the market reaction, so the yen usually gets hammered quite a bit. Or I shouldn't say hammered, but there's more volatility with yen pairs compared to some of the other currencies for non-farm payrolls, and you can see that that's quite evident here with how the dollar yen has reacted compared to everyone else. And of course, it has a high amount of liquidity in it, so it's a favored trade for a lot of currency traders. So in here, we're looking at the bond prices, 2-year bonds, of course, being the closest to the shorter end of the yield curve, sees the biggest market reaction compared to the 30-year. See, there was about 46 ticks towards the downside on the initial market reaction. Okay, this is going to the wick of the candle, and the figure in the brackets. Whoops, don't want to remove that. The figure in the brackets, the black brackets here, shows you the market reaction 10 minutes after the economic release has come out, going to the end of that candle. Okay, this is all on a 1-minute chart, by the way. And the figure in the blue brackets here represents the market reaction 30 minutes after the market reaction has occurred. So I did get someone who asked for an article or like a setup thing. I think I'll add that here to the deviations and ranges sheet as like a separate tab that you can have a look at, just kind of refresh yourselves with how it works. But yeah, so just to make that clear for you now, that's done there for you. So if we get out of this here, you see here, as I said, there wasn't that much of a deviation. Albeit the market reaction wasn't as strong when you had a much bigger deviation. There still was a bit of a decent move, but the telltale sign is how quickly it reverses. So the initial market reaction was about 74 ticks down. After about 10 minutes of trading, it reversed that and was 13 ticks up. So if you are looking for a bigger market reaction, you would be looking for a much bigger deviation. And if it is for that 6K deviation, at least on the high end, and about 155 on the low end, then you'd want to be looking for that. Otherwise, you'd kind of be jumping in and out with this sort of trade, rather than getting more of a sustained market reaction. Yes, this is available, so you can subscribe to the MACROACE mailing list, and you'll get access to there. Now we have Canadian employment change. I will put out the link for you guys to here. Let me just send that here. There it is. So this is how you can get access to the ranges and deviations sheet. Okay, so let's go through the Canadian data then. Okay. Okay. All right. So that. Okay. So with the Canadian employment data, same thing. I'll kind of skip this over. But we'll kind of go through this here. Same thing with how the markets react to non-farm payrolls. So a previous report in November, which was released on December 1st, had the areas of where there were 16,000 jobs that were created in construction, a loss of 18,000 jobs in finance, a loss of 27,000 jobs in wholesale retail trade, and an addition of 28,000 jobs in manufacturing. Where's the economy at the moment? So interest rates remain unchanged at 5%, inflation at 3.1%, average hourly earnings unchanged at 5%, GDP quarter, third quarter annualized minus 1.1%, and Q2 at minus 0.2%. GDP month on month was at 0% compared to 0.1%, and you have the figures from the last employment change there. So employment change came in at 24.9k compared to the prior of 17.5k. Unemployment rate did tick higher to 5.8% compared to 5.7%, and the manufacturing PMI did decline to 45.4 compared to 47.7. Then the triggers for the economic release, you see a high estimate of 30k and a low estimate of 15k, with a with a deviation of 15k and a low estimate of minus 10k, so about a 25k deviation. Unemployment rate sees a high estimate of 6% and a low estimate of 5.8%. And if we look at sentiment and views, then sorry, bear with me 1 second. Okay, so we had Macklem that said on December 18th that he sees the Bank of England, Bank of Canada, cutting the overnight rate in 2024. Bank of America said that they see the first rate cut in June 2024, then 3.75% by the end of 2024, and they cite inflation to further decline towards target. Also, what Macklem did say in December, he said on the 15th that they expect growth and jobs to be picking up later in 2024, and inflation getting close to the 2% target. So as long as you don't see a much stronger than expected report from Canada, then it could be a positive for the stock market there, and a negative reaction for the Canadian currency if you do get a much weaker than expected Canadian employment report. So investment bank views, so TDC 12k as their forecast for the figure, BMO 20k, Scotiabank 25k, and Bank of America see 18k. Okay, and this is the market reaction from last time around on December 1st. You can see that there was strengthening from the Canadian dollar off the back of the data. So there was about, you can see there's about a 10.9k, or let's say 11k deviation on the figure itself. Not a huge deviation for the Canadian data, but it still led to the Canadian dollar seeing some strength off the back of that. Again, the video, which is not working for some reason, is I'll just have to give you a screenshot here. Okay, that probably worked out better as well because we've got about 2 minutes left to the economic release. So we've got CAD JPY here. Let me get up the deviations quickly for the Canadian employment change, and let's have a look here. Okay. So this time round, where we see the biggest market reaction was actually in GBP CAD for the currency pairs of what we had seen so far. So GBP CAD, actually I'll bring that up on the chart here, but GBP CAD generally has seen the strongest reaction out of the markets compared to everyone else. Okay, less than a minute to go. Well, let's get this here. Let's go ready to go. Okay, this is GBP CAD. All right, so I'm going to get my TICKSTRIKE ready, and we'll see what figure we get here. Okay. Okay. All right. 10 seconds to go. So I'll go quiet for a little bit on here. Okay. Okay, that's the trade I've got at the moment. Okay. So let's close this out. Okay. All right. So there's a heavy amount of selling going on. All right, so let's go through the figures then. So I made a quick little trade there. So on that release, so 216k with a forecast of 175k. And let's see what else. So yeah, so here we go. So as said, it's seeing the euro dollar, sorry, the dollar C an appreciation here off the back of that stronger than expected data. If we're looking at elsewhere too, so we had average earnings, which also ticked up 4.1%. Okay. Oof. Markets are taking a hammering here. Average earnings also ticked up for the month as well. Again to 0.4%, so more or less unchanged from the prior. Manufacturing payrolls increased to 6,000k. And what else do we have here? The Canadian data, let's have a look at what they had there. 0.1k for their release there. So more or less flat. GP CAD did see there was a bit of weakening there. Let's look. There was a bit of excuse me, some some strength there from the Canadian dollar. At the back of that release. Okay. Let's see, what else do we get? Okay, let's have a look at the S&P. Let's see what happened here. How big of a move did we get? Okay, about 58 ticks. So not as strong as last time with the last market reaction from the data that we had last time around, but still a decline off of the stronger than expected data. Let's have a look here. So 105k, let's go to 105k, 105 ticks towards the downside on the Dow. Let's look at the dollar yen. Okay. And about 79 pips towards the upside on the dollar yen there. Apologies if I sound sniffly. Hopefully that's not coming through in the mic. That's not something anyone would want to hear. Okay. And on gold, 117 ticks towards the downside there for that data. Let's see. It's 10 TICKSTRIKE sensitivity all down to 1. Get that out of the way. All right, ladies and gents, that concludes the trading session for the day. Yeah, happy New Year to you too, Najabs. Yeah, you said happy New Year, Tony. Looking forward to making good money with you this year. Happy, and I also look forward to making good money with you this year too. Yes, so enjoy the rest of your weekend. Hopefully, you have good luck in your trading. I'll be sending out an email Monday morning if you've subscribed to the MACROACE mailing list. The MACROACE mailing list, just to describe it, is a short summary of what's happened, what to look out for in the week ahead in the Europe, US, and Asia session. I mean, when I say short summary, it is short, maybe like a small paragraph here or there. Okay, it's not extensive unless there needs to be any sort of explanation for what happened in the prior week, which would have affected sentiment this week. Other than that, also, there's the links to the live streams as well for the upcoming economic releases. And of course, you get the access to the ranges and deviations, which is completely free to have a look at as well, which is all in one place. So, I said the link is there in Macro in the live stream for you to have a look at. And then on FinancialJuice, where we get a live voice and text service. If you're not sure of what it is, what we do is provide live voice and text for all our users to be able to stay up to date with what's going on within the economy, in the markets. You can see here, traders off the back of that data. So, okay, let's see about 55% chance for March start to the Fed rate hikes versus the 65% seen before the jobs data. Okay, there's also some money, some repricing as well from the ECB and also the Bank of England. So that's how much of an effect non-farm payrolls has on the markets and is or has had in terms of pricing for the not only the Federal Reserve but also central banks as well. Albeit not too much really for the Bank of for the ECB. A bit more for the Bank of England, but not a huge amount, really. But still quite important to understand the sentiment shift for the day. Let's say it might not even last. It could even last longer than a day, but we don't know that yet. But that's the current pricing in. So all this stuff here is quite important to stay on top of. And here you have your live voice feed, which is there, which I've just clicked here. On the left-hand side, you have your economic calendar with all the upcoming economic releases for the week and also the day. In the middle, you have your news feed as well to have a look at. Again, all in one place. So providing you with live voice and text service about what's going on in the markets, what's moving the markets, the news as well, geopolitical news, what central bank members are saying, all in one place. So you can get access to that if you sign up to FinancialJuice, which I'll provide the link here. Now, this will take you to the, if you do sign up initially, it'll take you to the live, it'll give you the live version of FinancialJuice, which has a delay. There are adverts that do play throughout the day on the light version. I said there is a delay across the whole site on the live version, but if you're not used to using a live voice and text service, then probably a good idea just to have a little play with it first and see if it's something that works for you or not, despite it being delayed. And then when you are ready, or if you do feel comfortable, then in the top left-hand corner where you see the logo, it says FinancialJuice Pro. If you click there, that will take you to a link that will give you a list of subscriptions, so you can choose for which subscription that you want for FinancialJuice. And then once you've paid for that, then all you're going to do is log out and log back in. Now, make sure first that you do have an account on FinancialJuice, the live version, okay? And then verify your account through your email. Then go back, select your subscription. Once you paid for it, then log out and then log back in to FinancialJuice, and then you should be able to see the pro version of FinancialJuice once you've done that there. Okay, right. I am going to rest my vocals, rest my weary head, but I didn't want to miss out on non-farm payrolls because I missed out on it before, so I didn't want to do it this time. All right. I will see you guys next week. I'll send out an email Monday morning. It's one email a week, and I'll give you the schedule for the week ahead. All right. Take care. Bye.